London, stock markets were routed around the globe on Monday, with European indices opening lower and bond yields rising as resurgent U.S. inflation raised the possibility central banks would tighten policy more aggressively than had been expected. Europe's benchmark Stoxx 600 fell 1%, its sixth consecutive day of losses totaling 4.1%, the biggest decline since the UK voted in June 2016 to leave the EU. All major indices in Europe fell. The UK's FTSE 100 dropped 1%, France's CAC 40 0.8% and Germany's DAX 0.6%. Earlier, MSCI's broadest index of Asia-Pacific shares outside Japan shed as much as 2%, its largest daily drop since late 2016. It was last down 1.5%. Friday's U.S. payrolls report showed wages growing at their fastest pace in more than 8 years, fueling the expectation for both inflation and interest rates to rise more than previously forecast. That sparked a global sell-off that continued on Monday. Futures markets priced in the risk of 3, or even more, rate rises by the Federal Reserve this year. This added fuel to a bond market sell-off, pushing U.S. 10-year Treasury bond yields closer to the magic 3% level, which will only increase borrowing costs for corporates following years of cheap financing, thus ushering equities further from recent highs, said Mike Van Dulken, head of research at Accendo Markets. Bond yields, which move inversely to bond prices, rose to multi-year highs across the globe.